This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 139 was recorded on November 1st, 2018. I'm Erik Townsend. Dr. Pippa Malmgren joins me as this week's feature interview guest, and we'll discuss what motivated her as a world-renowned political consultant to turn to entrepreneurship and start a commercial drone company. She also has a new book out, Leadership Lab, which we'll discuss at length. Be sure to stay tuned after the feature interview when Patrick and I will provide extended equity market coverage.
And I'm Patrick Ceresna. Now, Erik, the S&P 500 sold right down to the 2,600 handle, right on the downside on Monday. And since then, we've hit a short-term low and a bounce. We're actually pretty much almost 130 points higher off of the worst levels at the start of the week. You know, it begs the question, is it all over? I mean, is this going to play out? I obviously have some opinions, but what's your thinking here on the S&P?
Well, I think you asked the key question. Is it all over? I would be very surprised if it's all over. But the thing is, nothing goes up or down in a straight line. There has to be some kind of bounce or retrace at some point, and I think probably it started now. I'll be surprised if the 2,600 that has contained this so far doesn't contain it at least for a little while. Now, as we get into next year, that's a whole nother story. I think that probably we've seen the top is in, maybe the top for the entire bull market. Maybe we're starting a new bear market. But even if we are, Patrick, we've sold really hard here down to 2,600. I would guess the most likely scenario, if I had to just guess off the top of my head, would be somewhere between a 50% and a 61.8% retrace in terms of fib levels on that move down from the all-time high to 2,600. So, we've got still a ways to go to the upside, and that could still be a failed rally and then new lows after that. But I think for the short term, Patrick, probably 2,600 is going to contain it for now. Of course, anything's possible. We'll see what happens.
Otherwise, do you think that the bull market peaks are in? Are you in that camp that this is it for 2018?
Well, I do think so, but I also have to put a really big caveat on it. We are in completely uncharted territory. Frankly, I thought the 666 number back in 2009 had more logical sense behind it than the 2,900 and whatever it was that we got to. I don't think that this rally that has been supported almost entirely by central bank largesse ever made a whole lot of logical sense, and I think that there's a potential for a really big downside here. If the Fed actually sticks to what it said it's going to do and does not bail the market out again. Now, I don't believe that that's really going to happen. I think at some point, if things get bad enough, the Fed will come into the rescue. So we're in totally uncharted territory, Patrick. I think maybe this thing is finally ending. But how does it end when you've had a 10-year-long bull market that has been supported by coordinated, synchronized central bank largesse in the form of balance sheet expansion? We've never, ever been anything close to this crazy situation that we're in, so we don't know what happens next. And I won't be surprised if it's really big downside, but frankly, there have been quite a few points since 2009 when I've said, okay, the top's got to be in finally, and it turned out not to be the top. Feels like it now, but, I've been wrong before. Who knows? We'll see what happens.
One thing that I'm going to be watching is how Apple behaves after the close. When we're recording here, we haven't seen Apple's earnings yet. But what's interesting here is that we have already seen Amazon and Google and Netflix all get hammered on and the FANG stocks just slowly falling apart. Obviously, Facebook already been in a multi-month downtrend. And so Apple is sort of like one of the generals that's still fighting. And it'll be interesting if someone pulls the pin on an earnings hand grenade on Apple after the close. If we see that, then it's going to be really hard to build a case that the market's going to have enough strength or momentum to push new highs. So let's see what happens. Otherwise, let's move on to the U.S. dollar index. And what we have here is a U.S. dollar that made it all the way back to its summer highs. And it looked like it was going to poke its head above and drive a new move. And then today, just at the time we're recording, we have almost a full point drop in the dollar index, obviously having lots of intermarket implications on other asset classes. But what's your thinking here on the dollar?
I'm not concerned quite yet. First of all, I think the chart overall looks very bullish. The thing is, how many days has it been? It's been all the way since October the 16th that it's just been up, 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 up. Nothing goes up in a straight line. We're overdue for some kind of a pullback. Coming back, we had broken through a resistance level that had been around somewhere around 95.6, 95.75, in there somewhere. So high 95s, that was the resistance level. Now it would make sense on just a normal bull market pullback to test it as support. So I wouldn't be surprised if we dip further down to, let's say, 95.5 before this pullback is over. At that level, it still doesn't concern me. I think the setup is still for a move higher. Now, if we start going below 95, that's another story. But as long as we stay above 95.5, looks to me like a long overdue pullback that's perfectly healthy, and I think the bull market is probably still intact.
All right. Well, I want to get to oil here because I wanted to get your opinion on this. Oil in like 30 days has wiped out almost 18% off the high from the WTI printing like near 77. We're down to $63. Just today, we beat the August and June lows on the downside. This selling is relentless. I won't lie that I've been dying for an opportunity short, but I've been waiting for some sort of a retracement where I can reset my risk reward. And I'm watching this thing just nosediving here. What's your take on this? Is this going to just keep going here, or are we so oversold that at some point this thing's got to bounce? What's your thinking?
Well, it's both of those things. I think it probably does have further to go to the downside, but as you say, we're way oversold at this point. There was a really big move down today on Thursday. So far, all that I can find as a catalyst is we broke down below the 200-day moving average for the first time in I'm not sure how long. I don't see any other specific news event that explained today's sudden move to the downside, other than perhaps it was just an acceleration below that 200-day moving average. Inventory-wise, we came in with a build of 3.2 million barrels. Now, of course, a build of inventory would normally be bearish, but it was a much smaller build than some people feared. API had predicted 5.7 million barrels. We only saw 3.2, so that breathed a little bit of sigh of relief. Prices went shooting to the upside, but it lasted for less than half a day. By the pit close on Wednesday afternoon, we were back down below the level where the data had come out. We ended up closing at a new cycle low on Wednesday afternoon. That kind of struggled into the middle of Thursday, and then we had that really big dump on Thursday, which I think was just the 200-day moving average giving up support, and people are not sure how much farther it can go to the downside. With respect to inventory, Cushing also built 1.9 million barrels, gasoline drawing down 3.2 million, distillates drawing down 4 million barrels. Exports, wow, 2.5 million barrels per day, 17.5 million barrels on the week. Production ticking back up to 11.2 million barrels. That's up 300,000 barrels from last week's report, and I think that's the same previous high that we had before. So we haven't quite broken out to a new all-time record, but we're within a tick away from it, again at 11.2 million barrels. There was also a sale of 1.5 million barrels from the Strategic Petroleum Reserve. So what we've got in terms of drivers, stocks are rising. There's economic woes. And particularly, Saudi Arabia really has egg on its face with this whole Khashoggi murder thing. It seems like it's just pretty darn clear that, they got caught red-handed. They did it. They lied about it. They lied about it some more. It came out that there was pretty strong evidence that Saudi Arabia did a premeditated murder on this guy. And I think that probably what the biggest driver is in the market right now is everybody knows that this is not a time for Saudi Arabia to be aggressive in pushing for higher oil prices. And I think that that's probably the main reason that there's a lot of fear and uncertainty that's come into the market, and it's allowed this selling to go this far. Now, frankly, despite the fact that Saudi Arabia is in a very embarrassed situation right now, Khalid al-Falih, the Saudi oil minister, admitted publicly that they're pedaling as fast as they can, that OPEC spare capacity is a myth, something that I have long been convinced of, but most people believe that Saudi Arabia, if they want to, can turn the valves and produce an extra 2 million barrels a day. We had Al-Fali come out and publicly tell the world, no, that's not true. They're pedaling as fast as they can. This is it. That, to me, should ultimately, in the long run, be very bullish because we know that Saudi Arabia doesn't really have any more spare capacity to contain prices getting too high if that were to happen in the future. So there's also a lot of uncertainty about whether or not Mohammed bin Salman is really at risk of being sacked, as there's another round of rumors saying that. The last round didn't seem to play out. We'll see what happens on this one. I think, Patrick, that what we're in is a sell-off that is being exaggerated. First of all, it's being driven by real fundamentals, rising stocks and economic woes, but it's being exaggerated by this situation with Saudi Arabia. And I think, Patrick, that there's a potential, if we continue to see rising stocks and continued economic woes, and particularly if the situation with Saudi Arabia's political embarrassment gets worse, we could see this really pick up steam. Oil market likes to kind of go in wild swings. We could see it really, really collapse, let's say into the mid-50s or even low 50s. If that happens, it's a really big buying opportunity because I'm convinced that Khalid Al-Fali's statement was true and relevant, even though the market is ignoring it. They're pedaling as fast as they can. They don't have any spare capacity. Peak cheap oil is a real phenomenon, and eventually we're going to get to the point where U.S. shale production cannot be increased at the rate it was previously, and we're going to have a really big move to the upside in prices. Looks to me like we're getting some artificial relief from kind of a perfect storm of events, and I think it's going to create a buying opportunity, but I don't think we're there yet. I think there's more to go to the downside.
All right, well, let's move on to gold because today, at the time of recording, we're at 1236. And last week's show, we were roughly around this 1235, 1236. It looks like it's almost unchanged, but we had a bit of a roller coaster move in the start of the week. We saw gold drop down to about the 1215 level on the downside, and we have a 20-point update today, bringing it back up here. With this kind of a momentum push, do you think gold still has room to for a big breakout here?
Well, to be sure, I'm watching it very carefully, although I would say today's move up was really to be expected. It's about dollar weakness. It was a major, major down day for the dollar index. As I said earlier, I don't think that was really anything terribly unexpected because the dollar's been so strong, and we're overdue for a pullback. I think we're most of the way there. So it didn't really surprise me to see gold up today. Also, 1215, which is what we touched yesterday, I think, that was the prior resistance just a few weeks ago. So we're going through the usual process of a market testing as support the same level that had previously been resistance. That's to be expected. So as far as this last move in the last couple of days, I don't think it's a big deal. I think it's entirely explained by gold moving opposite the dollar. But the thing is, that move on October 11th, where we broke trend with the Chinese yuan, and all of a sudden there was a move up in gold at the same time the dollar index was moving up. That is still unexplained as far as I'm concerned. I've read quite a few different commentaries from people who claim with great confidence to know exactly what caused it. They're all possibilities, but I have not been persuaded of any one specific explanation. There does seem to be some kind of new regime where it's not just about inverse relationship to the dollar anymore, but this latest action in the last couple days, I think, is nothing more than inverse to the dollar. So I'm still on the fence about whether or not we're headed toward new lows, let's say below 1150, but something has changed in this market. I'm going to continue watching Charlie McElligot's 1245 line in the sand. That was the level above which Charlie said that he expects that there would be a large amount of program buying from commodity trading advisors who work on computer-driven trend-following models. We should come back to that topic in Postgame, Patrick. I know you've got a couple of charts on it.
All right, let's move on to the 10-year Treasury yield, which is more or less hovering around the 315 handle right now. We've obviously had a bit of a pullback from that 325 print that occurred back in October. But what's your thinking here? What's the next direction for these interest rates?
Well, I think it's really important to note that this 310 to 315 level seems to be holding now as support where it previously had been resistance. So again, from a technical analysis standpoint, we seem to see indications that suggest that the bear market is on, and furthermore, that this could be a good short entry opportunity right here. In the interest of full disclosure, I have not traded this yet. I've been tempted by it, but I'm kind of waiting to see what happens. It feels to me like there's so many levers here at the same time. I'm kind of waiting to see what the stock market does. But if we start to move up again from that 315 level toward 320, I think that my move may be back on toward 330 or even higher. And maybe it is time to be shorting bonds here. Certainly, we did not see any serious move below the previous resistance level, which seems to now be acting as support. So all indications to me are the bear market in bonds is on.
Erik, last week we announced that we're doing MacroVoices Live out in Vancouver on January 19th. We're looking forward to it. And we announced all of our guests last week. So why don't you give our listeners a quick update?
Well, Patrick, I want to keep this quick out of respect for our listeners who don't have interest in attending. But briefly, ticket sales have been quite brisk. Remember, you've got till November 15th for the early bird discount. So be sure to get your tickets quickly if you want to come and join us. Again, we have Jeff Snyder, Julian Brigden, Juliet DeClercq, Louis Vincent Gav, Art Berman, and one other guest still being negotiated. If you're interested in joining us, please check out the full details at macrovoices.com/live. You can find all the information about the event there. I want to leave it at that out of respect for everyone's time.
Well, thanks for the update, Erik. Now, this week's featured interview guest is Dr. Pippa Malmgren. Erik's interview with Pippa is coming up as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Dr. Pippa Malmgren. Pippa, everybody on this program knows you for your past appearances as a geopolitical consultant and analyst and advisor to two U.S. presidents, never to mention a consultant to the government of the United Kingdom. Very geopolitical and government background. It's so out of character, it would seem. As a former tech entrepreneur myself, the last person that tech entrepreneurs ever think of as rolling up their sleeves and building something are geopolitical analysts that are engaged in government. But you are also the founder of a robotics drone company, H Robotics. So give us the personal story here. How did you get from advising U.S. presidents to rolling up your sleeve and starting a company to build drones?
Well, here's the thing. I was in the markets advising big institutional investors for many years, first at Bankers Trust and then UBS and then on my own. And what I found is I could be right. I could make really big calls. Like, I sold everything before the financial crisis. I told all my clients to sell everything, to ask critical questions about the stability of the firms they worked for. And I was right, but I couldn't really make any money out of it because I didn't have a balance sheet. So over the years, I've been very aware that I needed to get involved in the real economy in some way if I wanted to participate in the performance. And probably about 6 or 7 years ago, I started to have the view that financial markets was going to start to shrink because the regulators were going to make it shrink, circumstances would make it shrink. The poor performance of assets would probably make it shrink. And therefore, you might make more money running a real business than running a hedge fund, which has turned out to be exactly right. So I was looking for an opportunity. I also thought that automation, robotics, was definitely where the future was going. So I started to talk to all my clients about it the same way I talked to them about the financial crisis coming. And in the same way, most people said, you're out of your minds. The real economy is never going to pay better than the financial markets. And a few said, actually, I agree. And one of them is my business partner, my co-founder of H Robotics, Wayne Harburn. So Wayne had been running the oil trading businesses for AIG, ABN AMRO, PNB Paribas, and he'd run a big family office out of the Middle East. He was a hugely successful investment banker, independently wealthy. And when he left all that, he was bored and he decided to go get a helicopter license. So he learned how to fly a chopper. And in the course of doing that, he realized that now the technology would permit the building of something much smaller that could carry out the same tasks as a chopper, and it would be a drone. Now, interestingly, we started to talk about this, and we started to look at who was building them and what was the landscape. And we noticed that it was mainly Chinese. And because I come from a geopolitics background, we started to think about what are the implications of owning the aerial view of the world. Because remember, at that time, still satellite data wasn't so easily available to your average Joe, right? Big companies might be able to access it at a very high price, but to get a real aerial view of your assets, basically the Chinese had a lock on that market. And our view was that they were building things that were, well, let's just say very much, they were built to be toys. They're fundamentally toys. And they weren't suitable for industrial applications, for mines in Africa. So we decided to build something that was robust and very deep data management. This is the only open platform in the world that you can attach pretty much anything you want to. And that's where the idea came from. And again, because Wayne comes from an arbitrage background, he views this as an arbitrage deal more than a manufacturing operation, if you see what I mean. And because I come from the side of advising about trends in the future, I'm kind of like, you know what? Instead of just talking about the world economy of tomorrow, which I'm always enthusiastic about, why don't I be part of building it? And that was how we started.
Well, my hat is off to you, and it's no surprise coming from you to see you branching out and doing all these things. But I want to go back for a minute to DJI, which is the leading manufacturer of drones. As you say, many of them are toys. But boy, they've got an awfully strong market. They've got the advantage of being, Chinese and therefore cheap, and they've also done a lot of work to build some really cool stuff over the years, and it works pretty well. So it seems from a barrier of entry standpoint like it would be really hard to break that market. But as you gave me a little bit of perspective on off the air, you think about this like Facebook, if it's free, then you're the product. What could be going on with DJI beyond the obvious selling really cool toys that fly around and take pictures of girls through their bedroom windows at night, which is what people seem to use these things for?
First of all, let's quickly review the landscape of this market. We're at the very beginning of this market. Goldman Sachs estimates it's a $100 billion market by 2020, so that's just around the corner. It's a stage of the market where it's as if people say, I like cars, and they don't distinguish in any way between a go-kart, a Ford, a Fiat, and a Ferrari. It's just they're all cars, and it's beginning to differentiate. So yes, the Chinese and others have come into the market strongly in the go-kart end of the spectrum, in the toy end of the spectrum. But what we make is a Land Rover. They're profoundly different. And I think the drone market is going to be differentiating very dramatically over the next decade. And we'll see probably as many different kinds of drones as we see cars. In our case, we're hoping that the fact that we've got an open platform that's agnostic, so you can attach within size and weight constraints that are not very rigorous, you can attach pretty much any new innovation the market comes up with. So any new camera, any new device, any new sensor, and the range of sensors being developed is truly mind-blowing. But everybody else, not just the Chinese, but everybody else in the drone industry, first of all, they insist on putting all the devices inside, which means you have no choices. You can't swap it out and put something else in. Number one. Number two, there are two philosophies that dominate this industry. One is Chinese, one is American. The Chinese philosophy is basically build to break, which is, consistent with the history in China. They like to make stuff that breaks so that you go buy another one once you've broken it. And right now, most people who are buying the toys are like, hey, I'm on my fifth toy, and I just they keep breaking out and really want to buy another one, which is why we see the sales flattening on the retail consumer front. So naturally, those companies try to soup these things up to make them, quote, industrial. But the fact is they were never designed for industrial use, and they're incredibly vulnerable to simple things like weather. So most of them, whether made by Chinese or anybody else, most of them, anything over 10 knots of wind, and you'll never see this thing again. If it rains, forget it. They're not waterproof. Whereas ours are stable up to more than 25 knots. They're totally waterproof. They land and take off from water. They're meant to be flown in very difficult, challenging conditions. So that's one thing. The second is the American philosophy, which is very interesting, which is the only person who can fly a drone has to be a highly qualified person, usually a highly decorated ex-military pilot. We just decided, look, if you're Bechtel, if you are Shell Corporation, are you really going to say to those guys, you can handle billions of dollars worth of equipment, right? Your engineers are the world's best, but you're not good enough to handle this drone. That's crazy. So we built a drone system that is incredibly easy for companies to deploy themselves, which means we're going to bust the business model of which is currently the dominant business model that companies use, which is they hire external people to come do a job. That's crazy because, first of all, that means you don't get any consistency of the data. Second, it means you have outsiders on your property who don't understand what your business is. Third, they own your data, and you have to pay them not only for the day, which is running right now in the US and the UK at about $4 or $5 grand a day for a guy to come with a toy who flies it manually, so you have no comparable data, and then they charge you for the data. And some of the prices are just egregious, to say the least. So it ends up that minimum you're paying $1 million a year annualized for this external person, versus you can buy a tool of your own that your own team can deploy that'll cost you something like £25,000 for a year. It's a no-brainer who you're going to go with. So these are big differences, but there's a final issue, which we think is probably the most serious issue, and that is the security of the data. Almost every drone, in fact, we cannot find any other drone in the world that separates physically the management of the autopilot, which is what makes the thing fly, and the actual data coming off that machine. We physically separate them. I guess everybody else puts them together on one sort of motherboard because they think it's, quote, efficient, but it's actually not. By separating them, we ensure that there's no possibility that your camera and sensor data is ever going to get commingled with the autopilot, because the autopilot occasionally gets updates. And whenever you do an update, there's also a download. Many drones, you have to plug them into your computer, especially all the toys. You have to plug them into your computer every 2 or 3 weeks. And every time you do that, yes, you get an update, but do you also do a download? That's the allegation that the U.S. military has made, is that drones, especially the ones made in China, are taking all your data. So now your data is not secure. So naturally, if you're running a company, this is of crucial importance. So to have them physically separated, so there's no possibility of that inadvertent leak or deliberate leak, is a very big deal to companies. I'll just finish by saying this. We work a lot, for example, with mining companies in Africa. These are the worst physical conditions you can imagine. And I can walk you through what we do for them because it's just fascinating and involves great stories about crocodiles. But before I get to that, here's the bottom line. If you have an aerial view of a mine in Africa, you know the value of it. And if you're bidding for those assets, is it a surprise that those who have that aerial view outbid everybody else by $1? How do they know what it's worth? Answer, because you let them fly over your property and you sent all that data. So I'm just saying, with our company, we decided that the security of the data was absolutely paramount. And the depth of the data and the ability to deploy any new innovation the market comes up with, that these would all be massive advantages that would mean you wouldn't even compare the go-kart with the Land Rover. It's not even a question of should I buy one from this company or from that company. There's a huge market for go-karts and Fords and Ferraris, but there's not the same market for Land Rovers, and that's what we do.
So let me just make sure I understand the data privacy issue. What you're saying, because of the way the DJI architecture works, which is the firmware gets updated. The firmware is the software that runs inside of the device itself. It gets updated over the internet all the time. So at any time, the Chinese government could send an update that says, hey, send all the pictures back to us. And they start getting all of that data. So just as it's been alleged that the NSA is spying on everyone through their cell phones, you're saying that the Chinese government is literally selling these toys all over the world. They're taking pictures and gathering what is probably much more accurate than satellite data in a lot of cases. So if you go back to the Cold War era of everybody's, spying on each other with satellites, we're getting a much closer view, and you're saying there's a very real risk that at any time the Chinese government can say, hey, send us all that data, and it gets sent back to them. Is that accurate?
Well, I want to pick out any particular country or company. What I will say is this: as people get more sophisticated about understanding what the data leakage risks are, they're going to be inclined to go with a platform that diminishes that risk to zero because it can't commingle these data points. I will say this: the allegation that has been made by the Pentagon is having a real impact, because companies, the first thing they say is, are your drones made in Asia? And the answer is no. We make them in the United Kingdom, and we make them ourselves. So we're not outsourcing. All the code is ours. We have completely built the entire system ourselves. In fact, we'll be making an announcement soon that we've gone a level further than that. And I just think that there's a market for that. There's a market, and definitely every big corporation we're talking to, the first question they have is about this. So clearly, it's an interesting point, because, how is it that some companies have become so large so fast? And are they state-backed companies? Are they truly independent companies? Again, we get approached by investors, and they say, well, some of the drone companies out there aren't really investable because they're perceived to be state-backed. So we just like to think, look, it's a huge market, and we're providing certain qualities that market demands, where others are not. And so that makes us different. And there's it's a big space for a lot of players. We just fulfill particular needs that I think are going to be more important over time.
Now, as a geopolitical person, you must have thought about this. It seems to me that drones are so cool, and, the toys are so pervasive these days. Every kid's got one. These things are scary. The DJI drones can travel as much as 4 or 5 miles from their operator and spy on things and take pictures and 4K videos and everything else. As we get to bigger drones that have the ability to attach payloads, which you're certainly delivering with what you're doing in the commercial space, Amazon is putting a lot of work into delivery technologies of carrying external payloads. At some point, it seems to me like, boy, this is technology that gets scary in the hands of terrorists. If you can deliver bombs and sticks of dynamite and so forth using a drone, it's a very, very low entry cost. So is there an angle to provide some sort of technological resilience to misuse of your product?
Definitely. And this is, again, exactly why we decided to enter this space, because we think that the retail consumer use of drones is going to be ever more regulated for a lot of reasons, not only because of the terrorism risk, which, I'm personally very sensitive to, because I was in the White House on 9/11, and I was in charge of terrorism risk to the economy after 9/11 for the president on the National Economic Council. So nobody gets this better than I do. But there are other risks as well, which is you get a 16-year-old kid who flies it at, 1,500 feet because it's cool and it's fun. But you're now in the, incoming lanes at Heathrow Airport, and we've seen several incidents. So I think more and more the regulators are going to say enough of this risk. And also, by the way, they just fall out of the sky. So, that's what happened to GoPro. So GoPro had this great idea. Let's take our wonderful cameras and get them in the air. And drones, that's simple. That's easy. We'll just outsource that to China. And they came up with the GoPro Karma. And if you recall, they all literally fell out of the sky, and they did 100% recall within a few weeks. And now they've announced they've gone out of that business completely, because it's very hard actually to create stability in the air. So all the regulators are very worried about drones for a lot of reasons. So we decided to build a drone that was only for companies and can only be flown by someone designated by the company. So I know this sounds like a technical detail, but it's actually quite important. We've created a system where there's a fleet manager inside the company, the client, and they designate every pilot within the firm, every flight that's taken, every access point to the data. So literally you could steal it, but you can't get into the system to turn it on. Even if you have permission to fly it, you can't hot dog with it without the boss knowing. And if you take it off the property, and remember, most of the corporate clients, they own the properties they're operating on, right? You own the agribusiness, you own the mining site, you own the oil and gas platform offshore. So this is not being flown in general places. It's in a very specific location. So we geofence them. So if it's taken off your property, you're going to get a text message saying, your device is leaving your property. Do you want to hit a kill code, which means it will never fly again? In other words, it can't be stolen by a terrorist and used for nefarious purposes. And it's exactly to your point. We think this is a big issue. And, people ask us, are your drones weaponized? And the answer is, well, we call it H robotics because we're making helpful robotics. So no, but let's put it this way. It can go 100 miles an hour. You can hold it in one hand. It weighs less than 7 kilograms. It has, 16, 17-inch carbon fiber props that are rotating at 7,000 RPM. It is a weapon. And so it is for toys as well. And people don't realize, and this is why we see terrible accidents, especially at Christmas time, where children get injured by drones because parents give a little kid this thing. But the fact is they are dangerous. And so we built the company on the assumption that the regulators are going to want something that is tracked and logged 24/7, that has all these controls on its use. It can be set with height and distance limiters so that it cannot be flown beyond the legal limit. And it's mainly going to be contained on company properties, and it's always going to be used by authorized personnel. But the other end of the spectrum, I think they're going to face a lot of difficulty as the regulators demand more and more of them.
Let's shift gears. I want to move to your personal experience, Pippa. You've gone from just radically different extremes of being in a career where basically you talk all day. You've got so much smarts in your head that you're able to get the attention of U.S. presidents. Congratulations on that. But you're not doing anything. You're talking about very, very important subjects with very important people. You've gone from that, and you still do some of that in your life, to rolling up your sleeves, starting a company from scratch, having an idea and saying, let's make this work. What have been the differences in terms of which is more rewarding? Which do you enjoy more? What are the surprises that you didn't expect in this transition?
Oh, it's such an interesting question. And remember, I've had a consulting practice for many years, and that is a business. So, and a public speaking business. So I have been an entrepreneur. It's just not perceived that way. But really, the big thing happened to me when I was in the White House working for President Bush, and we went to do the tax cut, actually. And I remember the fundamental point that hung on was, do you believe that entrepreneurs are smart enough, switched on enough, that they will understand that we're giving them the opportunity to go build, to instead of having their money go to the government and the government allocates it into the economy, that they get to decide what they're going to allocate it to, plus their time and their energy. And, this is still a huge philosophical issue of debate, with many people believing that tax cuts are stupid and government ought to be in charge of allocating the wealth in the economy, and other people who take the opposite view. So I remember I was up in Cape Cod on my only vacation that I took while I was in the White House. It was a long weekend, sitting in a lobster shack, like a really local lobster shack. And the guys at the next table, I overheard their conversation. They were all fishermen. And, Cape Cod fishermen are tough people, right? Remember the film made about, how with George Clooney, where they all went out, and a bunch of them, got killed because they'll take on any storm. And I listened to them, and they were talking about our tax proposal in as much detail, with as much nuance as any discussion I'd been in the White House in the previous few weeks. And I'm like, these people know exactly what it is on offer. And I was so impressed. I felt like, I want to be part of that crowd. I want to be like those fishermen in Cape Cod who are taking really big personal risks with their lives as well in order to make a living. And so I've always had it in my mind that I wanted to be part of it. Then the other thing is, that it might have this tendency to have big views, right? Like inflation's going to come back. China is going to have a big slowdown. Trump is going to get elected. Brexit's going to happen. These are big long-term views. Well, one of them was about, 10 years ago, right after the financial crisis, I thought, you know what? We're going to see the real economy roar back to life because the regulators have thrown a record sum of money at the real economy. And if I really believe that, if I'm going to go around telling people that the recovery is coming, I should put my money where my mouth is. I should be in this thing. I should find a way to be part of building this thing. And again, that's when this conversation with one particular client started to turn into a kind of sketching the back of the envelope and then playing around and wiring some things together and then really thinking through. And then I'll give you one last piece of the story. About 7 years ago, Wayne, my business partner, and I noticed that the Chinese introduced an autopilot into the market, and they basically dropped the price of the autopilot by 40-fold in a single year. Now, I can understand why you might cut the price of an autopilot. This is the thing that makes the drone fly. You might cut the price of an autopilot in half to get market share. You might drop it by, 60%, but to drop it 40-fold in a single year, it completely wiped the business models of every single drone manufacturer at the time. And it opened the door for us because now we could, at that time, buy an autopilot for practically nothing. And that was when I started to think, what is the purpose of that? Is it really about market share, or is it about flooding the market with instruments that are capable of gathering data? And again, who knows what's the security around that data? I don't know. But what I do know is that this changed this market, and it opens the door for me to get in there and provide a tool that provides security over that data. And so again, could I have done it if I hadn't been in geopolitics? I would never seen that. But because I came from that background, I understood this. So sometimes in life, it's these multiplicity of perspectives on things that make the difference. The last thing I'll say too is, I come from a family of immigrants. My grandmother was 16 when she came from Sweden to the United States in 1930. And at that time, there were no jobs. It's the beginning of the Great Depression. Actually, I think she might have arrived in 1932. So, just as things are really getting bad. And she didn't speak any English, and she got someone to read a sign in a window that basically said seamstress work. And she went in and said, I can do that. And she had never even seen a sewing machine at that point, but she's like, I can do that. And she ended up as the personal seamstress for Mrs. William Randolph Hearst. In other words, she made it from not speaking English and never having seen a sewing machine to being the top haute couture seamstress for the wealthiest woman in America. So I'm like, you know what? You can build anything. You can be anything. And if I really believe that, and I want to encourage people to participate in the new robotic-led economy, what better way than to do it myself? And to finish, what I've built empowers people who don't know anything about robotics. One of the most exciting things that's happened to me with this company was when we took it to deal with clients in Africa. The people flying the drones are not professional pilots. They're just employees of the mining company. And some of them are women. So now I have these African women who have no background in robotics, automation, code, anything, and I've empowered them with a tool that they can fly. So it's a great example of what I mean, that we don't need to be afraid about robotics stealing our jobs. They're actually going to augment us. So that's a key theme I talk about as an economist. It's a key point I make as a policy advisor. And now I'm just putting my money where my mouth is as a manufacturer.
And in addition to putting your money where your mouth is as a manufacturer, you're also putting your mouth where a lot of people like seeing it, which is writing another book. And that one is titled Leadership Lab, Understanding Leadership in the 21st Century, to be published October 2018. Now, if I take that title, Pippa, it sounds like it could be just another mundane management book, but I know you better than that. So I'm guessing it probably has to do with why the future of civilization hangs in the balance depending on whether or not leaders can get their head around new paradigms that they don't understand yet. And I bet you explain it in the book. Am I on the right track?
You got it in one. That's it. Exactly. So here's the thing I realized, how is it that all of our leaders keep being totally blindsided by populism, blindsided by Trump, blindsided by Brexit, blindsided by technology? How is it that we live in a world where the guys at Volkswagen felt they could falsify the data and no one would notice? How can we be in a world where leaders of every kind, religious leaders, political leaders, community leaders, they all keep making decisions that reveal they don't get it. They just don't get it. So I co-authored this book with a friend of mine, Chris Lewis. Now, Chris is a Brit who founded the second largest privately owned PR agency in the world, Lewis Media. And he authored a book called Too Fast to Think, which basically says we're never slowing down enough to think properly about what's going on, which was kind of the predicate of this book. And I had written Signals, which was all about how to see the signals coming so you don't get blindsided by all these economic events. And we decided to bring together a whole bunch of leaders from every area, from politics, from business, from religious, from community, and put them in a room and talk to them about leadership in the 21st century. And what we found was that most of them were stuck in a mindset that we thought was very 20th century. They were not prepared for the 21st century. So I'll give you a few thoughts on what I mean by that. 20th century leadership was literally about the leader. And we idealized and made into icons our leaders. I think 21st century leadership is much more about the ship. It's about the organization. It's about the people. It's about inclusivity. It's about crowdsourcing ideas within and without your organization. That's a totally different way of thinking. Second, the book is about how we need much more diversity of thinking. Everybody's focused on diversity of people, and I applaud that. I want to see vastly more diversity of people on every level, not just gender, not just ethnicity, but also personal background, income levels, neurodiversity, the way our brains are wired are different. But none of that is as valuable if what you end up with is a whole bunch of people who still say things like Brexit will never happen or Trump will never win. There's no diversity of thinking there. So the book suggests that we need to do a lot more with scenarios. And so stop trying to predict and get much more focused on preparing for possibilities that strike you as crazy. And another core idea is drilling down into detail, which is the 20th century iconic skill that every business school taught, right? How to go deeper into the balance sheet, how to get a black box model that's going to give you the magic answer. Yeah, this did not work so well. 21st century leadership requires looking across the landscape, connecting the dots between the silos and thinking parenthetically across. So now the quantitative has to be met by lateral qualitative thinking, which is something that people are not as comfortable with. And I think they're going to have to get a lot more comfortable with that. So the main message of the book is that just leaders have to understand how the landscape has changed, and the skill sets required of them are very, very different. And the people and the environment are different. So I have a lot in the book about technology, huge amount about how technology completely changes everything. And so whatever leadership skills that worked in the 20th century, they won't work in the 21st unless you really get on top of technology. It's kind of like I get a lot of leaders who are, in their 50s, 60s. To be perfectly frank, there are a lot of middle-aged guys, and they go, I'm not really very tech savvy. And you're like, sweetie, if you don't do tech, tech is going to do you. So if you want to get in front of all this, this is the book for you.
Pippa, this book has already gotten a huge amount of attention. Greg Williamson is just a god in the pension world who has described it as the art of war of the 21st century. Ken Todolov, who was the former deputy head of the U.S. Missile Command, has said this book is required reading for everyone on his team at Northrop Grumman. You're getting a lot of attention, and I want to just give our listeners a sense of a couple of the major themes. One of them is technology. You got to get it. And this is something that has really just blown my mind. I've done a lot of research recently on where I think digital currency is headed with government-issued digital currencies. And it is shocking. If you look at what the cryptocurrency crowd has done, the ignorance of government, it's not that they don't believe in it or they don't like it. It's that they have no clue what it is. They don't get it. And the inability of senior leaders in government to understand technology is something that I've always thought would eventually, catch up with them and bite them. It sounds like you're saying that's really, the day has come. If you don't get technology, you're going to be in real trouble. So how is this going to play out? Because you and I both know that senior government officials don't get technology. They're lost.
Well, it's not only government officials. I'm finding that it's also people in the business community, especially in big corporations. And they keep being surprised that little tiny companies with 2 or 3, 5 people are suddenly able to burst onto the market and take all their market share. And it's because they really don't understand the radical revolution that is being brought about by artificial intelligence, by computational power. And so, these big guys, they think that size saves them, and they're wrong. They're completely wrong. Little companies are springing up out of nowhere that are radically transforming the landscape from, Uber at one end of the spectrum, Facebook, SenseTime in China, which will touch every company in the world, what SenseTime does with their facial recognition. So part of the problem is this thing we talk about in the book, which is quantum superpositions. Now, that sounds like a heady concept. What it means is you can have 2 extremes that are true simultaneously now. So, for example, we have unbelievable amounts of information. So everyone, by all rights, should be able to understand what's going on with technology. But at the same time, everyone is inundated. They're so inundated, they shut down. They stop reading. I hear about even chief technology officers of big companies saying, we have a blanket ban on any new technology until we figure out what we already have. And you're like, that's not going to help you. So the overload of information for leaders and this inundation is blocking them from being able to understand what they need to understand about technology. So in the book, I go to great lengths to describe the new technology innovation environment so they can begin to see that some teenager is going to eat their market share within a couple of years. And this should not come as a surprise to them, but it does. And I'll give you another example of what I mean by a quantum superposition that we talk about in the book. Big companies are very much under siege about their taxes. Look at Amazon's under siege by the regulators in Europe, but, everywhere in the world, people are going, okay, big companies like that are paying almost nothing often in taxes. That legally they are totally in compliance with the law. They're absolutely, totally square. It's not that they're doing something they shouldn't be doing. But at the same time, the perception is that this is just wrong. You shouldn't be able to do that much business and not have to pay something in tax. And therefore, there's nothing for that society to work with to pay for whatever the societal needs are. So you can be both right and wrong simultaneously. It's this, I may not know the story of this guy, Sir Bradley Wiggins in the United Kingdom, who he won the big cycling championship, the Tour de France. And he doped with a substance that it was not on the avoid list. In other words, he definitely deliberately doped himself to win the race, but he used something that technically wasn't on the list. It was like an antihistamine or something. Well, how does the world feel about Bradley Wiggins now? On the one hand, he's totally discredited, for some people because he doped. For others, they're like, hey, he was absolutely compliant with the law. So this is the key point. How do leaders understand quantum superpositions and take the time to get deeper into technology? Because if I always say to them, because they say to me, look, I don't do technology. And I'm like, you know what, honey, if you don't do technology, it's going to do you.
There's another theme that you focus on in the book that really resonates for me as a pilot and flight instructor, which is the theme of situational awareness. And it's something we teach in flying. Is it's not good enough, especially flying on instruments, to just know what the altimeter says and what your heading is and so forth. You've got to have a picture in your head of what's going on outside of the airplane, where you are in reference to the airport, to the obstructions, to the clouds, to the weather, to everything else. And you've got to have that picture in your head all the time, or you're screwed. How does that translate to a book about leadership in the 21st century?
Well, this is so interesting that you're a pilot and you get this. This is a military concept as well. And people in the military are trained to have a high level of situational awareness, which is that so nobody sneaks up on you, basically. So in business, what happens to a lot of leaders is the higher they go, the less time they have to just talk to people. So they tend to start talking to all their old mates who they've known a long time and they have a high level of trust with. Or they talk to other leaders, right? They all go to Davos together and they all chat there. And so they say, I know what's going on because I've talked to everybody. Now, doesn't this ring a bell that this is exactly how they missed the financial crisis? It's how they missed the election of Trump. They're like, oh my goodness, I'm completely surprised. No one I know was voting for Trump. No one I know was supporting Brexit yet, because your situational awareness has collapsed into a very small group of people and only looking at certain, as you say, altimeters, certain instruments. You're not actually looking around to find out what's really going on. So a lot of leaders will say, well, I've just been to China and I know exactly what's happening. But they don't, because going is not knowing. They went and they talked to, let's say, Xi Jinping's team. And of course, they have a particular view, and it's unlikely to be a negative one. Same as if you say, I've been to Washington, and I've talked to everybody in Washington, and this is what's going to happen. You're like, well, sweetie, Washington is not where all the action is in the U.S. economy. So if you want to understand what's really going on, you've got to spread to deeper, broader sources of information. And that is what gives you situational awareness. I was on a stage recently at the Google Zeitgeist conference. They hold 2 events every year, one in the States and California and one in London. So this was the London event. And I was on stage with Jennifer Palmieri, who is absolutely fantastic. She was Hillary Clinton's advisor on the campaign. She served President Obama as special assistant to the president. She was the head of communications for the White House. This is a bright, switched-on person. One may or may not agree with her politics, but she's a first-class policy person. And we had a conversation about how did you miss what happened, this sea change in American politics? And she was like, we just didn't see it. We didn't feel it. And how is it possible? And the answer is because if you're in your own little world, you don't have situational awareness. And that's why the book spends a lot of time helping leaders today, but much more specifically tomorrow's leaders, really get a grip on how to have situational awareness, how to think about scenarios that you think might be crazy, but actually might happen, and to have a more open-minded approach so that you basically save yourself from accidents that are unnecessary, just like flying.
Pippa, before we close, there's one more point I want to hit, which is so interesting because it's so out of consensus. You have kind of a radical view about inflation. Tell us what's on your mind.
Well, in the book, I have a whole section that argues against the current commonly accepted wisdom that the internet is deflationary. I give a view that maybe the internet is inflationary. Now, that'll twist a lot of people's brains around, but it's a good example of what I'm doing in the book, is how to get you to think differently.
Pippa, I can't thank you enough for a fantastic interview. Listeners, the book will be released on October 4th in the UK and October 20th in the United States. Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
MacroVoices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. You can email questions for the program to mailbag@macrovoices.com, and we'll answer them on the air from time to time in our mailbag segment. We also welcome your suggestions for how we can improve the program. Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, I always love having Pippa back on the show. She goes from being a geopolitical consultant to owning a drone company to now writing a book about all the things leaders need to know in the future about leading. It's so amazing to hear her perspectives on this. What did you take away from the interview?
Well, I agree with all of that. She is an amazing woman all the way around. But, there's something I find interesting just because I'm seeing a trend here. Pippa wrote this book, I think, really because she feels a passion for expressing what's important in this world. And I don't think it's a marketing book. I don't think she's trying to sell anything. I read the book and, it doesn't push any of her services or anything. And I noticed, too, we've got another guest coming up next week who is a regular on this program that everybody loves. Okay, he's got a new book. And, of course, I assumed what you'd normally assume, which is, okay, the guy wrote a book that basically is a thinly veiled, marketing pitch for his company. The book has nothing to do with his company. It is because we're seeing a trend, Patrick, of really smart finance guys saying, hey, the world is a screwed up place. We really need to write books and take the insights we have about what's wrong with the world and how to fix it and get them in print where maybe they'll do some difference. And I think you're going to really enjoy next week's interview because the other guest that I'll keep secret until next week is one of our favorite interviews. And the book has nothing to do with his business. It's a completely different subject that he just feels passionate about making a statement about in this economy and in this situation that we've come to in capital markets. But Patrick, rather than wax philosophical, I want to get to your chart book. Listeners, you'll find the download link in your Research Roundup email. It says Postgame Chart Book. Patrick, I think that probably the theme here is maybe the bounce is on because I don't think the overall downside is necessarily over yet, but it feels like the initial wave is perhaps over, and we're seeing the bounce, the retrace. Do you agree with that? As we look at chart 2 here, what do you see, particularly as we start to move into this green box that's defined on your chart here between 27.35 and 28.25?
Right. So the point I wanted to make with this chart is just a way of sizing up the risk-reward proposition of buying here. So obviously anyone who bought the dip at 2,600 earlier in the week is looking like a rock star right now. But right now the big headline, is it over? Should I buy? And everyone sees the market ripping higher and is now considering getting into the market here at this kind of 27.35 level where we're trading. And I really just wanted to kind of size up the opportunity now that we've already 130 points off of the printed low. The one thing to me is that all our listeners have to ask themselves a simple question. Do you subscribe to the view that this entire correction was just going to prove to be a big buying opportunity and that the stock market is about to go back to its highs and make higher highs? Under that situation, there is certainly an opportunity to buy in here. But if you subscribe to the view that we're just getting an incredibly oversold bounce and we're going to get some form of a retracement that just undoes the very heavy selling that we saw through the month of October, well, by all accounts, a target back just above 2,800, in my mind, be a very respectable target for where the sell-off would retrace up to. And what I'm trying to illustrate here is simply that already, if you're buying the market today at 27.35, the risk-reward proposition is rather poor. I mean, to make it back to that swing high that we had in the latter part of October near that 28.20 level, you're probably looking at this stage of about an 80-plus point upside. But a retest of the low that has happened in the past, that would entail a 120, 130-point risk. It's already a pretty poor proposition. And I kind of wanted to rewind on this chart going back to the March and April part at the beginning, because obviously we had the big February market correction that happened happened very quick on that blow up. But then we retested the lows back in March and going into early April. Now, when those lows came in on the first day of April, the market just basically went up for the better part of the next 6 months. But what's important to note here is that during that period of April, the market went back and retested the lows on multiple occasions, including having 80-point and 100-plus point throwbacks in the market. And it was incredibly volatile for an entire month before the bulls were able to get their footing and drive the next rally. I'm just thinking that while I'm not really on the very short-term bearish, thinking we're about to go to 25 or 2400 or something like that, at the same time, I'm not overly excited about buying here either.
Well, I want to turn that around because what you just said is if you believe the scenario that this is a buy the dip opportunity, we're headed to new all-time highs, blah, 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 blah. We covered that. Now let's cover the other scenario. I don't believe that. I think the more likely case is that we do some kind of retracement. I was guessing just off the top of my head, 50 to 61.8 on the fib level from the top to the bottom, 2,600 up to 2949 or whatever the number is. What is the trade if I have the opposite longer-term view? Is it short 28.25? Do I wait and watch the tape action to tell me what that level is? How do I know when it's time to short if I have the opposite view?
That's the art of market timing, isn't it? Obviously, from a price level perspective, somewhere give or take around 2,800 plus is an interesting level where the risk reward starts coming into your favor to short. But rarely does the market make it easy to do so. And there's going to be probably a number of very noisy entries that will have those periods that are going to shake out the weak hands that are trying to get short too early. So I think that even if that level, give or take around 28.50 becomes a right level to short, I think it's going to be rather messy up there unless you know what you're doing as a trader, which many of our listeners do. It's not something that I would just blanket buy put options at that level without having a real kind of game plan on how you're going to trade it.
Let's move on to the dollar index on page number 3. As you're showing here, we actually didn't just have a double top. We went a little bit higher than the previous top, but now today we've got a really big red candle. I'm personally thinking that, it's a scary looking candle, but I don't see a really big news catalyst for it. And frankly, it looks to me like we've been going straight up for a couple of weeks here. What do you think? Is this the beginning of a big change, or is this just a little setback?
Well, you know what? I remain bigger picture bullish the dollar. I don't think that one day down like this should ever be enough information to change a bigger macro trend. But what I'm actually asking, which is much more interesting, is that are we still potentially going to spend a better part of the year consolidating before the breakout occurs? Like, what if this dollar retest on this high ends up being a defined range and the dollar retests down on the downside and chops around? The reason this is relevant is when we're trying to talk about gold and the other things this has a big implication for a lot of asset classes. If the dollar's ripping higher, and there's a lot of negative implications on a lot of other cross-asset relationships if it was. But at the same time, if the dollar rejects here and ends up consolidating, even if our bigger picture view is bull dollar, that could fuel a little bit of risk on a number of asset classes. And so that's really what I wanted to point out on this chart.
So from a consolidation perspective, where do you think the bottom of the consolidation range? Is it down around 94 or so?
Well, that's certainly the bottom of if it was just going to trade sideways, of course, targeting the September low at 94 would be that. But I don't think it has to go that low. I think it's much more about the fact if it's not going higher, right? Like whether it's going to just consolidate to 95.50 and then trade sideways, or whether it goes to 94 and then bounces around. I think the bigger question is there a bull breakout that's actually ripping it to 100 on the upside, or are we continuing a consolidation? I think that's the bigger question to answer than what level it's going to.
Well, and I also think, there's some overhead resistance. I don't think we quite got to it. But if you look at the bigger picture from what was it, 103 spot 80 something, whatever the high was more than a year ago, down to the bottom at 88, 89. I don't even remember the exact number. If you look at the 61.8% retrace of that, the number is 97 point something. And of course, the point something is not specific because this is just an oddity of futures trading. Whether you're looking at the continuous chart or the December chart or at the spot chart, you get three different numbers in terms of where that fib level is. But it's just a little bit above where the highs have been. So my take has been that, there's going to be some pretty significant resistance before we get to 98. Once you clear 98 and a half or so, I think it's pretty smooth sailing up to 104. Or whatever the previous high had been. But if you're right and we consolidate here, particularly if we move back down to, let's say, 94 and a half, let's move on to page 4, because if the dollar were to come back down to 94 and a half from current levels, that would probably take gold above that 1245, which was Charlie McElligot's line in the sand that you have in the bottom of these two red horizontal bars here. Tell us what you see and what you think might be coming.
The whole point of the chart here on gold that I have is I put the volume by price levels on there, and I really wanted to show that there was a very strong high volume consolidation in this kind of 1190 to the upper boundary being this kind of 1230 area. And this is where the big consolidation happens. So this is where it makes a lot of sense to use Charlie McElligot's 1245 level as a trigger, because any gold breakout above that level, and let's say there's a continued CTA short covering in that period, there isn't a lot of resistance there. If you look at the kind of void of volume transactions that occurred in that $50 space between like 1240 to 1290, there was very little activity in that area, which basically means it's like an air pocket where if given the right fuel, we could see 1300 on the upside of gold very quickly. Now, I'm not super bullish gold just yet, but technically there is room for this still to go. I don't know if there's going to be much more upside above 1300 plus, but it certainly could be something that we see here. Be very interesting in the next week to see whether or not this breakout happens.
Let's come back to our discussion of interest rates from the market wrap, Patrick. What do you see? I see you've got a chart here on page 5 of LQD, which of course is the investment grade bond ETF. Why this chart, and what's this telling you?
Well, I really wanted to just first share a chart on looking at both the investment grade corporates as well as the junk corporate ETF, and just really kind of get a sense of what the trend is. Now, a lot of the downtrend we've witnessed in both of these is just in correlation with the downtrend in Treasury. That's where we want to talk about the credit spreads. But I wanted to give just a solid base for looking at the price action as we go into what I really want to talk about on the page 6, which is the actual credit spread between what are the BBB rated corporate bonds over that of Treasury. And that spread has more or less been hovering in the last, let's say, 2 years in this kind of 1.2 to 1.6 area. In fact, you can pretty much define the 2018 year, the majority of the price action between that 1.4 to 1.6 credit spread over Treasury. Now, what's interesting here is, are we about to see the breakout? And are we about to see the credit spreads widen as this is playing? And I want to get to the point of this in a second. We're moving on to page 7. We have the bigger weekly chart going back to 2014 of the junk bond ETF JNK. Also, the price action in the last 2 years has been dismal. After a very oversold bounce, it's been a very slow, methodical bleed in the junk bond space. But overall, a lot of this selling that we have witnessed in the junk bond space has been more or less in tune with what we've seen in Treasury bonds. But again, going to now page 8, we're looking at the credit spread of junk bonds over that of Treasury. And we've basically been pinned since the start of 2017 in this range between 3 to 4%. And this is a topic we've had many conversations with guests in the show over the last year, particularly, when we touched on with it with Jeffrey Sherman from Double Line when he was on the show earlier this year. And again, we went on the credit spread from trading trading at like 3.25 just like a month and a half ago to suddenly being on the verge of breaking 4% here right now. And so this is an important thing. Are we about to see the junk bond market send a very important message about what's happening next here in the markets?
Well, and I want to ask you a question about this, Patrick, and maybe I'll pose it to our listeners as well, because this, again, is something that several of our guests have pointed out in the program. If I look here at what appears to be an incipient breakout on the junk spread on page 8, yeah, okay, it's about to break above 4%. Great. So maybe shorting junk makes sense here. And you could do that by shorting the junk ETF or by going long the inverse ETF, which is SJB, short junk bonds. Now, that seems to be the trade, but when you go back and you look at page 6, and you say, wait a minute, the triple Bs, which are the just barely investment grade, they're still down at 1.6. And if we have the kind of bond market event that I predict is coming eventually, I don't know if we're upon it yet, but maybe we're seeing that breakout. I think what's going to happen is a lot of that just barely investment grade stuff is going to get downgraded when there is a big bond market sell-off. And that is going to force institutional sellers. They have no choice. If it's not investment grade, they have to sell it, whether they want to or not. And that results, as you get from triple B down to junk ratings, potentially a slingshot move from this 1.6 yield that we're seeing on the triple Bs to, let's say we're moving to a 5% yield on the junk. You could see triple Bs that get downgraded just really collapse in terms of value. So I want to figure out, how do you get short the lowest quality of the triple Bs? I don't know any way to do that. And if any listener knows, short of having an ISDA and being able to put together, an institutional trade, if there's a way through publicly traded instruments to do that, I sure don't know what it is. I would love to be short the triple B bond ETF, but I don't think there is a triple B bond ETF.
One of the ideas, though, I have, and which I want to share in the next couple of slides, is, well, you can, do exactly what you're suggesting. Try to find some way of actually profiting from the actual move in bonds. But there's a second way of trading it, which is learning to understand what is the implications if this was to happen, and then what would be the impact on all other asset classes. Then you can turn around and express the trade through currency, through the equity markets, through all sorts of other means, right? And so for a retail investor that doesn't have an ISDA account, it might be a better way to express the trade by looking at the implications of it rather than putting it on directly onto the bond market, right?
So what do we have on page 9 here? What is this chart telling us? Because there's clearly a big divergence all of a sudden between the yellow and green lines.
This is where I think the fuel really comes in. So, the way I know junk bonds anyway is that they have to pay a premium over that of Treasury because there's a certain percentage of junk bonds that default. And by doing so, you have to build in the default risk into the premium you're earning. And what's really interesting on this chart is going back, 30 plus years of what it does. It shows the cycle of corporate debt as a percentage of the U.S. GDP, and subsequently oscillating that against that of the default rates that occur on junk bonds throughout the different cycles. And what's interesting is there's always been a very clear correlation between the debt as a percentage of GDP and the spikes in the default rates. But yet we've seen the trend in the last decade be completely different. Default rates here are literally right on the lower boundary of around 2%, as though we're in an incredibly healthy bond market. Of course, when you lower interest rates so low and provide so much liquidity as the central banks of the world have, there's not much reason for these corporations to be defaulting, but yet the corporate debt as a percentage of GDP is actually at a record high level, north of 45%. And so to me, what if they start to converge? Maybe it doesn't have to go back to the peak levels of 91 or 2001, 2002, or even in 2008. But these have diverged so far that if you have default rates just jump to 5 to 8%, the yields right now are not pricing any of this in. I mean, that's a big downside for junk bonds in my mind. What's your take on that?
Well, I think this is so frustrating for me, Patrick. I have been talking about and observing that the junk bond situation is crazy and that the spreads are too low and that I thought the junk bond market should collapse for like 3 years now. And as usual, I've been way too early. So maybe it's finally starting to happen. But, about a year ago, it looked like it was finally starting to happen, and it was kind of a false alarm. And I suppose a lot of people made a lot of money trading it, so it wasn't a false alarm. But certainly in terms of what I thought could happen, which is a blowout to, 10% spreads between treasuries and junk, that kind of blowout, we didn't have anything close to it. I do think that's coming at some point, but every time I try to call that, I'm early. So we'll see what happens.
Right. So what I wanted to do, though, on page 10 was just do a little blast from the past. This was originally a slide from a double-line presentation by Jeffrey Gunlack. And we had that same chart book that we were speaking with Jeffrey Sherman, who during the interview when we had him on the air, we were talking about this high-yield spread and how it can be used as an indicator for a countdown to a recession. And this idea that are we 6 months from a recession or 1 year from a recession, like when you see that these credit spread starts to widen, bond traders, which tend to be the smartest of the group, and when they sniff out that a recession is coming, start to demand much higher premiums for the risk that they're undertaking and holding this stuff. And so, if we see a blowout above 4%, going back to 2007 and subsequently it was more around the 5-6% level in 2001, when we saw those credit spreads really start to widen out of the range, that started the countdown clock to a recession. And it would be interesting to see if we have that breakout. Does that mean that the recession is becoming much more imminent as a solid 2019 story?
Patrick, there's no doubt in my mind that we are overdue for a recession, and I think that we've managed to stay overdue for one for a long time because of artificial factors coming from central banks. The question is just whether it's over yet, and I like to think that maybe we're finally at the end of this game. I'm afraid what it could spell next. We'll see what happens, though. Meanwhile, though, I want to mention a couple of other things before we close the show out because we could use our listeners' help. We're producing a little video, a Twitter-sized video about MacroVoices Live. We'd sure appreciate your help in retweeting that so that we can expand our audience and try to bring some more people in for our January event. Again, keep in mind you've got until November 15th to get the early bird price to get your tickets to join us in Vancouver. And finally, there's also a free video that you've got available, Patrick, on your website at bigpicturetrading.com, which is how to catch market tops using options. So be sure to check all those things out. We'll be back next week. Meanwhile, we need your help promoting MacroVoices. So please tell your friends and colleagues about MacroVoices, forward your Research Roundup emails, and most importantly, register your free account at macrovoices.com. It only takes a minute, and the benefit to you is you'll receive our free Research Roundup email, which never contains any marketing or advertising. It's just a compendium of links to all of the best content we could find on the internet each week. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, you'll find a transcript for today's interview. There's also the link to the chart book that we just discussed in this postgame. There's also an interesting link to Jesse Felder's blog where he wrote a piece on the .com deja vu, as well an interesting article from Bloomberg about the Saudi prince starting to pay political price for the Khashoggi murder, as well as an interesting article discussing Neil Ferguson's perspective on the destructive power of social networks. So you'll find this and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we'll include it in our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.